With Chipotle's stock price over $3,000 per share, stock market investors are eagerly anticipating the 50-for-1 stock split. So, should you buy Chipotle stock before or after the stock split? I'm going to answer that question in this video, looking at the company's fundamental prospects on revenue and profitability, on new store growth, and comparing it to its valuation on the forward price to earnings ratio, not the market price, to determine if long-term investors should add Chipotle stock to their portfolios. Let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so Chipotle in its latest quarter increased revenue by 14.1% to $2.7 billion. Comparable restaurant sales increased by 7%. Now, the difference between total revenue and comparable restaurant sales has to do with new stores that were opened during that period. Chipotle generates growth in two forms. Number one, by increases in sales at existing locations, supplemented by new locations. Chipotle plans to add roughly 300 new locations this year, and in the most recent quarter, they opened 47 new restaurants. Now, this is an increase from a couple of years ago when they were opening new stores at a rate of about 200 stores per year. But since the performance has been so excellent, Chipotle has accelerated new store development. Now, the operating margin increased to 16.3%, which was up from 15.5%. Diluted earnings per share were up by 24% to $13 per share. Overall, Chipotle has been an excellent performer in the restaurant space. The company has been able to pass along rising costs to customers, increasing the price of nearly all of its menu items several times. And since many of Chipotle's customers are in the higher income category or higher than usual for this fast casual dining category, they're able to sustain those customers or keep those customers even after all of those price increases. Customers still shop or still buy from Chipotle. That's been the good news. Now, longer term, Chipotle has maintained this revenue growth. You could see revenue up to $10.2 billion. That was up from less than $4 billion in 2016, following the food outbreak that caused many Chipotle diners to get sick and sales to fall tremendously. Since that catastrophe, Chipotle has recovered nicely and sales have absolutely exploded. That's allowed it to recover its operating profit margin. Before that food sickness disaster, Chipotle's operating profit margin was closer to 20%. That collapsed close to 2%, and now it's working its way back up to 16.71%. Chipotle is one of the few companies that I give credit to for managing the pandemic extremely well. They were both one of the fastest ones to identify and adapt to the quick changing conditions during the pandemic. When the restaurant was closed for in-person dining, they pivoted nicely and quickly to the takeaway or take-home category or delivery category, and they sustained revenue during those times. And then when economies reopened and consumers were able to dine in, they benefited from that as well. So they were one of the few companies that did well, both going into the pandemic and coming out of the pandemic. The list of companies that did well in this category are relatively few, and Chipotle I have among those. I would have to also give management credit. The new CEO has done a great job at the helm at Chipotle, really improved the business, improved the marketing, improved the pricing on their category of items, and sustained customer loyalty even through the price increases. That hasn't been an easy thing to do. I've seen many other companies, many other restaurants that tried to pass along price increases, and consumers said, no, thank you. They stopped going to those locations. Chipotle, even though they increased prices, they retain customers. So they're doing something right, customers like it, and they keep going back to Chipotle. Now, the analysts that are following Chipotle stock, they think it's going to grow earnings per share at 22% per year over the next 5 years. That's roughly twice the rate of the average company in the S&P 500. Chipotle's cash flow from operations to sales is also increasing phenomenally well, up to 18.6%. That's up from those bottoms around 9% in 2017, again, following those food sickness disasters that Chipotle had to recover from and is recovering from nicely. However, all of that has to be weighed against Chipotle's valuation. The performance of the business, as I've been talking about, as I've been discussing, has been really great, but the stock price has reflected that. As I mentioned in the beginning of the video, Chipotle's stock price is up to $3,100 per share. That's roughly triple where it was in 2020 at $1,000 per share. So those excellent prospects, those excellent performance have been incorporated into Chipotle's stock price. It's now trading at a forward price to earnings ratio of 47. Chipotle, listen to this remarkable statement. Chipotle's stock valuation in terms of forward price to earnings is more than 50% more expensive than NVIDIA. NVIDIA is trading at a forward price to earnings of 30. Chipotle is at 47. So Chipotle is trading at a roughly 1.5 times valuation of the hottest AI stock in the market. That's how rich Chipotle's valuation has gotten. Chipotle's stock price is getting more expensive than Chipotle's food items. And Chipotle's food items have gotten really expensive. So that's how expensive this company is. Now, to answer if investors should buy Chipotle stock before or after the stock split, I would say neither. Unless after the stock split, the valuation also comes down, which has little to do with the market price. The valuation, the forward price to earnings ratio, measures what you're getting in return for the price that you're paying. So when the stock splits, you're also going to get a fraction of the earnings because the result of the stock split does not change the earnings per that you're getting in return for the price that you're paying. You're going to be paying a lower price, but you're also going to be getting a lower share of the company's earnings because you're going to be getting 1/50th of what you were getting before. So all that being said, agreeing that Chipotle is an excellent business, I feel the valuation is too expensive. Even after the stock split, I worry the valuation will be too expensive. So to answer, should you buy the stock before the stock split? I would say no. I would say this is a hold. This is not a buy right now at current valuations. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.